15 of 21 series are aligned with a stagflation mild configuration this morning. That is a moderately coherent read where growth and inflation move in opposite directions. The current macro regime is stagflation mild, with a confirmation score of 15 out of 21. Under the framework, this macro regime describes an environment where growth momentum is decelerating at about minus 0.20, while inflation momentum is accelerating at roughly plus 0.01. The coherence score is moderate, and the confirmation score of 15 out of 21 places today's regime in a mid-range band of alignment rather than an extreme clustering. Historically, by our framework's reckoning of comparable conditions, regimes with a confirmation score in this area have persisted in around 41% of cases over 3-month windows, with acceleration a state where both growth and inflation momentum strengthen together as the most frequently observed next regime. Compared to last week, confirmation has firmed slightly as more of the 21 series moved into agreement with the stagflationary profile, even as growth deceleration has softened and inflation acceleration remained in place. In our historical sample, environments like this have often felt mixed across markets. Broad equity indexes tended to chop sideways, defensive sectors and real assets more often held their ground, and longer duration fixed income faced headwinds. A record of past behavior, not a roadmap. On the rate side, the 10-year Treasury yield sits near 4.62%, with the 2-year around 4.26% and the curve modestly steepening. Markets watch this because the shape of the curve summarizes how policy expectations and long-run growth and inflation assumptions line up. The question it naturally raises is whether this term structure challenges or supports current positioning in duration and rate-sensitive assets. The engine tags the curve configuration as green momentum, defined as a widening of the 10-year minus 2-year spread by more than 10 basis points over a month, with the long end bearing more of the move. In our framework's reading of comparable periods, this roughly coincided with firmer inflation metrics and more resilient commodity prices within 3 to 6 month windows. An observation under our methodology, not a forecast. What would challenge this read would be a renewed flattening, with the spread compressing back towards zero. Labor conditions are the second major signal. Non-farm payrolls and broader employment composites have cooled, with hiring momentum decelerating and measures of job creation losing speed. Participants watch labor data because it anchors household income, default risk, and the breadth of demand in the real economy. The question it raises is whether slower hiring alters how much cyclical and consumer-sensitive exposure feels appropriate. The engine marks labor as red momentum, defined as payroll growth slowing by more than 0.25 percentage points over a rolling 3-month window compared with the prior quarter. In our framework's reading of comparable periods, this roughly coincided with softer performance in economically sensitive sectors and a tilt toward more defensive equities within subsequent months, an observation under our methodology, not a forecast. A counter move, a reacceleration in hiring or a clear inflection higher in job gains, would challenge that configuration. Credit spreads and funding conditions form the third signal. Investment grade and high-yield borrowing costs have remained contained, with no pronounced widening in spreads between corporate bonds and treasuries. Markets track this because credit is the transmission channel between macro conditions and corporate balance sheet stress. The question for allocators is whether credit pricing still matches their view of default risk and earnings resilience under mild stagflation. The framework currently reads credit as yellow momentum, defined as spreads moving less than 15 basis points either way over a rolling month. In our framework's reading of comparable periods, this roughly coincided with range-bound equity indexes and selective sector rotation rather than broad breakouts within 1 to 3 month windows. An observation under our methodology, not a forecast. A meaningful spread widening would challenge that neutral stance. The fourth signal shows up in cross-asset sector rotation. Technology has pulled back, with the sector index down about 2.4%, while energy equities have advanced over 3%, and utilities and financials are modestly higher. Investors watch these rotations because they speak to where markets are assigning earnings resilience and pricing in inflation or rate risk. The question this rotation raises is whether portfolios have the balance they want between growth-sensitive sectors and more income or inflation-linked exposures. The engine flags this as green momentum for energy and defensives, defined as a configuration where energy and utilities rise more than 2% over 10 sessions while growth sectors lag. In our framework's reading of comparable periods, this roughly coincided with more persistent inflation prints and flatter overall equity gains within a quarter. An observation under our methodology, not a forecast. A reversal, with technology leading and energy fading, would challenge that reading. Turning to the conditional map, two if-then triggers sit on the dashboard. If the 10-year Treasury yield crosses 4.45% and holds that level or higher for 5 consecutive sessions, in our framework's reading, inflation composites have historically shown acceleration in roughly 9 of 11 comparable conditions. A historical characterization, not a forecast. In those past environments, the regime matrix more often migrated toward higher intensity expansion to acceleration dynamics. If the Fear and Greed Sentiment Index drops below 15 and holds there for 5 consecutive sessions, in our framework's reading, the confirmation score has historically deteriorated in roughly 7 of 9 comparable conditions. A historical characterization, not a forecast. Those episodes more often recorded fragmented macro conditions and a regime watch setting rather than a tight cluster. The map is live. These conditions are being monitored daily across all 21 series. Atlas is the automated rules-based engine inside Given Analytics. It does 2 things in parallel. First, it publishes a view of the macro environment, the regime, the confirmation score, and the historical base rates we just covered. Second, it runs a fixed 4-layer mathematical framework: price structure, rate of change, risk regime, and market participation, across 407 liquid symbols every trading day. When all 4 layers agree on a symbol, Atlas records it as an upside-aligned or downside-aligned condition under the framework, a reading of how the 4 layers line up, not a trade. These are time-stamped model readings, logged for members to study. The environment view and the condition log sit side by side inside Atlas. They are separate outputs. The regime does not pick the symbols. The 4 layers do. Members use Atlas to study how the framework has recorded conditions across prior environments, as historical behavior, not as trade selection. Atlas runs the framework. You study the outputs and environment. You decide what to do next. The entire design is potential, educational, a structured way to look at the math rather than a set of instructions. The morning brief is the public surface. The live Atlas dashboard shows the full 21 series regime map, today's mathematical conditions across 407 symbols, and the historical archive side by side. Members study the environment and the Atlas outputs each morning. If you want to track this alongside us, the live view is at givenanalytics.com.